Why don't we start with what exactly is private equity?
Sure. So private equity, the way that most people describe it, are leverage buyouts. So the leverage buyout community in the early 90s changed their name to private equity because LBOs got a bad rap. Well, maybe deserve a bad rap, but it had a negative connotation. And it was very clever. So technically, private equity would include anything that's not public equity. It would include venture capital. It would include real estate. But really, when we think of venture capital, we think of venture capital. Private equity is really leverage buyouts. That's the way to think about
it. Okay. So what is a leveraged buyout then?
Okay. So no problem. So a leverage buyout is when a firm buys a company using the company's assets as collateral. So think of you or I buying a house. We put 20% down, let's say, borrow 80%, the house is ours. The difference with a leverage buyout, and that's the same way to think about it, is they put about 20 to 25% down, maybe 30%, but usually nothing more than that. And the money that's borrowed to finance the rest, the house borrows the money, not the buyer. So if we buy a house and we lose our jobs and we don't have the money, our house will go into foreclosure. And we declare bankruptcy. If a private equity firm buys a company, which happens, of course, the company can't pay the debt. The company will go bankrupt. The private equity firm will not. But that's a leverage buyout. You're buying a company on leverage, and it's a nice marketing tool to call it private equity because it makes it look like they're providing equity. In reality, they're not providing much equity at all, and they're putting the company in deep debt.
Okay. So I guess the first question I then have about this is where did this idea come from? Has it been around as long as the mortgage has been around as such, or is this something that's like a new invention of finance in the way like an MBS hasn't been around as long as mortgages have?
It really started in the mid to late 70s. Guys like Henry Kravis, who's still around, KKR, was one of the pioneers. And they started as an experiment. So the reason why leverage buyouts tend to be profitable for the buyer, one big reason, is because if you put a company in debt, that company doesn't have to pay, they can take the interest they're paying on their debt off of their taxes. So companies acquired in LBOs pay less than half of the taxes than a peer does who just has a modest amount of debt. So they thought you could buy a company that has dependable revenue that you don't have to do much to, or let's say a widget maker, for lack of a better way of putting it, load it down with debt, pay less in taxes, resell it, you can do really well. And in the early days, that did happen. There was a greeting card company, American Greetings, bought by William Simon, the ex-Treasury Secretary of the U.S., in the late 70s, early 80s. He made a fortune through a leverage buyout. So the first leverage buyouts generally did very well. And then the industry got bigger and bigger. Michael Milken funded a lot of LBOs. The Michael Milken of Drexel, who ended up going to jail. And the problem is once you have too many leverage buyouts, well, it's harder and harder to find widget makers or companies where if you put them deep in debt, there's no damage. Chaos theory does happen in business all the time. Life's unpredictable. So that's basically what happened. It became very big in the late 80s. We had a financial crisis. Milken goes to jail. They go away. They rebrand themselves as private equity. And they have become, over time, bigger, much bigger than they were in the late 80s. In the U.S., private equity firms own companies employing about 1 out of every 10 Americans in the private sector. So they're that big. They are not, where you are in England, they're not as large, but they're certainly important. And they have become global. They weren't really global in the late 80s. So private equity has become very, very big. And it all started from an experiment in the late 70s. And private equity firms even though a lot of their companies go bankrupt, because of the fees they charge, they rarely lose money, and it's proved to be a very profitable part of Wall Street.
Okay. It seems like the system, that particular system is being set up to encourage companies to go into debt and then end up paying more taxes. Is that one of the kind of the problems that this creates?
I think so. The tax code, and this is not new, but the tax code is set up to encourage, the U.S. tax code anyway, and that actually is true in much of the world. It is set up to encourage debt. And the theory may have been, whenever it was set up, long time ago, 100 years ago, to encourage companies to borrow money to build a plant, hire more workers. Mm-hmm. But it's not, you can borrow money for other reasons. And that's, so yes, this was really started as a giant legal tax loophole, and it's emerged into something much, much bigger. And as you probably know from reaching out to me, I would say something much more destructive. Mm-hmm. And I think the record proves that. Yeah. But yes, it really started out as a tax loophole, and it's something that any government could close pretty easily. But although it's been talked about in the U.S. and other countries, most large companies have not done it.
Okay, so you said that originally it had been quite successful in a way, that there was a couple of some examples where the company was able to handle the debt, that they were able to grow, and then the private equity firms or LBOs had then sold it on at a profit. But the problem was that they ran out of good companies to do this to, basically, or ones that could at least handle the debt. Is there any other problems in your mind with this practice aside from the fact that they're targeting companies that can't handle it?
Well, typically, not that you've asked, but just because it's a misconception about private equity. What they would like to say, what they do say when they're criticized, is we buy troubled companies. Mm-hmm. That is not true. They typically buy companies with dependable cash flow. They are not looking for fast-growing companies. But banks finance LBOs. Banks are not going to finance a company that they think is going to go into bankruptcy in a year. Generally, these are dependable companies like Morrison's in the UK, which is being targeted right now. Mm-hmm. They like companies with lots of assets, with real estate, that have a leading market share. They are not looking for troubled companies. There is a small subsection of private equity that does that, but that's a pretty small subsection. Generally, that's not what they do. And besides the fact that they put companies in deep debt, I guess another thing that bothers me intellectually and as a journalist is you are putting the hands of a lot of the economy in a few firms. You know, even if it's 50 large Wall Street private equity firms, a few being in London, mostly being on Wall Street, you're getting not a diversity of thought. You get a company that's not in their community, where guys who run these firms can do pretty cutthroat things that maybe if they went to the same country club as people in that community, they would not be doing. And it's consolidating wealth in the hands of a few. And whether one is on the left or the right, I think that that's something that disturbs a lot of people, and I think it should disturb a lot of people. And it's not because they're growing businesses. Whatever one thinks of Jeff Bezos, and you can, I think there are intelligent opinions you can have on either side of that argument. Bezos built Amazon. There wasn't something there. He created something that now is filling a big need. He also might be taking advantage of small businesses in the process, but whatever, at least he's creating something. A KKR, a Blackstone, a Cinven, they're not creating anything. They're buying existing companies, sucking the life out of them sometimes to varying degrees. Sometimes the companies survive. Typically, they're not as good as they were when they bought them. That I showed in my book. Almost all the time, the company is worse off. Some of the time, they go bankrupt. And they are making money because if you buy a company, putting little money down and resell it, even for the same price, if that company's paid down its debt, or much of its debt, you're going to make a nice profit. And they collect very nice fees from their investors. So I think private equity firms often destroy value. And again, I think the record shows it. It doesn't even have to be anecdotal at this point. And they lay off workers because you're putting a lot of debt on a company. It's all about increasing cash flow because you put a lot of debt on the business. So I think there's a lot of reasons not to like private equity. With Bezos or Walmart or pick your, Facebook, there are reasons to like or not like them, but you cannot say Zuckerberg didn't build a business. You can't say the Waltons didn't build a business with Walmart. And customers do pay lower prices than they would at competitors. Again, you could argue we should have lots of small businesses and Walmart destroys them, and that's not good for the economy. They don't pay their workers right. You can make those arguments. But did the Waltons build something? Yeah, they sure did.